Okay. Um, I think I can start. Munira, should I start now?
Yes, yes,
Oh,
Savita, you can start.
thank you so much, Munira. So good afternoon, everyone, and welcome to this session on capital markets, emerging money laundering trends. It's going to be a short webinar of an hour. I'll uh, try to finish off within 45 minutes so that we can have time for questions as well. Any questions are welcome. And this is a series of webinars which we have been having, and especially I started off with KYC in capital markets, compliance in capital markets and ESG trends. And today we are going compliance, basically compliance in capital markets relating to ESG. And today I'm going to discuss capital markets and emerging money laundering trends. So when we talk about emerging money laundering trends, I would probably say it is more or less continuing trends as well. So we will be talking about that. If you do have questions, more than happy to answer. You can ask me questions. Yeah. My name is Savita, and I'm a senior lecturer with BIBF. I've been in training in anti-money laundering compliance, etc., for the last uh, 11 years now. This is my 12th year with BIBF. Um, so let's start. So the topics which we are going to cover today is going to be why are capital markets vulnerable? And as I mentioned earlier, it is going to be recent and continuing trends. So I'll be talking about mirror trading. And this is something which is perturbing now. If you look at it, hiding beneficial ownership. That's something which is a bit of a worry when it comes to money laundering in general. I will not restrict it to capital markets, but money laundering in general. So we'll be discussing mirror trading. Insider trading is a sort of continuing trend. This is not a new trend, it's a continuing trend. Wash trading, another continuing trend. Greenwashing, again, well, is it money laundering? Is it related to money laundering? Of course, environmental crimes is a predicate offense. It has been classified as a predicate offense. And anything that supports environmental crimes, like uh, claiming to be green while you're not, will definitely be part of financial crime. And so that's why I've included greenwashing as well. And then, of course, I'm going to talk a bit about cryptos and ransomware for sanction breaches. Now, this is a very limited topic relating to sanction breaches, how the ransomware payments, that is, which is normally in cryptos, can lead to sanction breaches as well, and what is to be done. So these are the topics I'm going to discuss today. And as I said, if there are any questions, you're always welcome to ask. Yeah. So before I start, let me give a disclaimer. This is very important because given the topic, it's a very important disclaimer. The case studies discussed in the session have been sourced from various publicly available websites. Neither BIBF nor me, Savita, the trainer, the presenter, the webinar presenter, vouches for the authenticity of the information. References of websites, etc., can be provided on request. Okay. So just a disclaimer to, because I'm going to discuss, I'll be naming certain case studies, etc. These are all sourced from publicly available websites. Okay. First, let us look at the positives. When we start something, I think it's always important to start with the positives. Is capital market vulnerable to the risk of money laundering? Well, they are highly regulated. Yes, capital markets are regulated. Um, the levels of scrutiny, there's a lot of scrutiny in every stage. There's a scrutiny in the onboarding process, in the trading process, in the settlement process. In every process there is a scrutiny. So given the level of scrutiny, that deter money launderers? See, when we talk about the stages of money laundering, let's say placement, layering, integration, capital market is much vulnerable in the last stage, that is integration stage, right? Because placement is difficult. In layering, probably, but more so, capital markets is vulnerable in the last stage, that is buying of capital markets products, bonds, shares, etc. That's where the vulnerability increases. But then there is a lot of scrutiny in every stage. So does that deter money launderers? Probably yes, probably not. And then the products may be too complex for a launderer to understand. Yeah, capital market products can be a bit complex for a money launderer to understand. So see, what is it that a money launderer is looking at? He is looking to legitimize his money. He is looking to make his money clean or legitimate. Yeah, that's his objective, and so that he can use it, he can bring it back into the system and use it, without fearing the prosecution, etc. So again, coming back, the products may be complex for a money launderer to understand. He may probably opt for simpler this thing. So there ends the positives. Does it? Or is there anything I'm missing? Any comments from the audience? Anyone who can use the chat box, or you want to talk about it? Do you think these positives are sufficient deterrent for a money launderer to use the capital markets? Or do you think we are still vulnerable? Anyone who wants to speak? Anyone who wants to answer? Well, okay. Okay. So let's move on. Okay, now the vulnerabilities. Now I'm going to the vulnerabilities. So let's start with. Okay, so Mariam has answered. Thank you, Mariam. It's still vulnerable. Absolutely, my dear. Given the recent cases we see, given the recent enforcements, if you look at the penalty, which is there in the bottom of the slide, it says 160 million, 63 million pounds and or $425 million, which is by the DFS, and FC, the Financial Conduct Authority, has penalized around 163 million pounds. So, okay, let's look at what happened. Almost every weekday between the fall of 2011 and early 2015, a broker called the equities desk of Deutsche Bank's Moscow headquarters. The broker would speak to a sales trader and ask her to place two trades simultaneously. In one, he would use Russian rubles to buy a blue chip Russian stock, such as Lukoil, for a Russian company that he represented, right? That the broker represented. Usually the order was for about $10 million worth of stock. So see, there are two red flags already here. One is two trades simultaneously, number one. Number two, the volume, yeah, $10 million worth of stock. In the second trade, the same broker, again, the same broker acting on behalf of a different company. So we have one broker acting on behalf of two companies, which typically is registered in an offshore territory. So as I'm speaking, I'm bringing out the red flags. So any capital market player, you may be a broker, you may be a clearing, you may be a, I mean, from the audience, anyone who is a capital market player, you may be an investor for all you know. For all of them, these are all red flags, right? So which typically is registered in an offshore territory, such as the BVI, would sell the same Russian stock in the same quantity. See, the same, simultaneously, same, two different companies, same broker in London in exchange for dollars, pounds, or euros. Both the Russian company and the offshore company had the same owner. So Deutsche Bank was just being used to help the client buy and sell to himself. Is that all? No, it was just to help move fund across borders. It's as conversion of rubles to dollars and moving across borders. This is what happened in 2017, right? It was between 2011 and 2015, but it was caught in 2017. So the penalty, as we see, is 163 million pounds and $425 million by the DFS. So what exactly is this? What are we discussing? Any idea what is this called? Anyone from the audience, what exactly such type of trades are called? Anyone? Such trades, my friends, are called mirror trading. It's called a mirror trading. Yeah. So what exactly is mirror trading, right? I'm not going to explain mirror trading from a generalistic specific this thing. I'm going to define mirror trading from in the context of money laundering, right? So mirror trading in the context of money laundering can be described as a scenario where two related but opposite trades. So the buying and selling mirrors exactly the same quantity, same time, the time is the same, the quantity is the same. One is buy, one is sell. So it mirrors uh, the transactions mirror each other perfectly. That is why it is called a mirror trading. So it can be described as a scenario where two related but opposite trades, one is a buy, one is a sell, are executed almost simultaneously, involving the same securities, quantity, and timing. The trade transactions are designed to just move the funds across borders. Why? Why? Because if you normally move between borders, between banks, a lot of questions are asked. Purpose, originator information. But here also they are asked, but it is routed through the capital markets. You got my point. So funds are moved from one financial institutions to another as if it is for payment of stocks that has been, securities that has been purchased. Yeah. The trade transactions are designed to move funds across borders while giving the appearance of a legitimate trading activity. So the trading activity, the capital market is used to move funds across borders by doing a mirror trading. This is what is called a mirror trading. So what happened? This is what we discussed previously. Now, who is vulnerable to this? Who is vulnerable? The capital market players, right? Brokers, right? They are vulnerable. Financial institutions, are they vulnerable? Yes, the funds are end of the day moved through the financial institutions. So they are vulnerable. What are the key takeaways for us? Where should we be careful? What are the key takeaways for us? Right? Let's, like I discussed earlier, there are some takeaways. So every time there is a trend, there is a typology we observe, there are something which we need to take away from the typology. For example, where should we be careful about? What are the vulnerabilities? What are the risk factors? What is it that we should be aware of? So what are the red flags, as we call it? The first thing is, these are unlisted entities. That is, they are not listed entities. The customers. I'm talking about the customers, the customer risk, as we call it. You're all familiar with anti-money laundering requirements, right? So we call it customer risk, product risk, jurisdiction risk, etc. So we are talking about customers. Now, if the customer is a unlisted entity, so what is the vulnerability of an unlisted entity? It can be a front company, which means there is a real business, but they are trying to hide illegal proceeds, with commingle illegal proceeds with the legal proceeds. Or shell companies, where there is no business, no mind and management, and there is no physical presence. It's just a shell entity. So now, first thing, as a capital market player, I need to know my client. We already discussed that KYC. I need to know my client. And if the client is an unlisted entity, I need to know who is the UBO, ultimate beneficial owner. We'll talk about it as we move on. We are going to talk about UBOs and what is the regulatory response, etc. So the first red flag in the case of mirror trading was, in this case, the customers were unlisted entities. Second thing is, customer was from an offshore jurisdiction. One of the trading entity was from a offshore jurisdiction, BVI, as you call BVI, or any other offshore jurisdiction. So the other thing is a non-resident customer from an offshore jurisdiction, another red flag. Then the third red flag is, the same shares were brought and sold at the same time, right? Quantity was same, timing was same. It was bought and sold at the same time. Another red flag for you. The volumes are huge. See, another thing, as a capital market player, you have to be aware is, the transactions should match with the investor profile. When I say investor profile, it should be the source of funds or source of wealth or source of income of the client. right? So for example, the investor, when we onboard an investor, we look at the source of fund, we look at the source of wealth, we also look at the source of income, right? Now the amount of investment should match with this, right? And the transaction volumes should also match with this, right? Just give me a second. I think just a minute. I lost my this thing. I'll just redo it. Yeah, okay. Just yeah, okay, got it. Sorry for this. I think are you able to see the presentation? I hope you are able to. Yeah, okay. So yes. Yeah, we were talking about matching of the profile with investors profile. So it's extremely important to match the customer profile with the transaction volumes. This is extremely important for a capital market player. So in this case, if you see the volumes were huge, then the rationale for the transaction. Always, every transaction should have a rationale. And normally for a capital market player, it is profits. Yeah. But yes, there should be a rationale for the transaction. That's another thing we as capital market players needs to look at. And then opening of several investment accounts by different companies having common partners, authorized signatories, managers, etc. Common partners, common authorized signatories, common managers, etc. That is another red flag. See, if two entities owned by the same person, yeah, or carrying out two simultaneous buy and sell trades, it can be a red flag. Yeah, I hope things are clear. Let's move on. Right. So what else? What else should capital market players be wary of? So we have seen what else should you be aware of, right? So the first thing, as I mentioned earlier, and this is another trend that is being observed, is use of third parties as to set up entities where the ultimate beneficial owner can remain hidden. That's another trend we are seeing a lot. So we have to be careful as capital market players. We have to be careful of entities that can hide beneficial ownership. Like for example, trusts, right? So we need to know who the settler of the trust is. We need to know who the beneficiary is, etc. Then the next one is entities with complex ownership structures. So if you have entities, yes. No, I'm on a webinar.
Yeah, she said it was stuck or something.
No, I'm okay. I lost the slides. Okay. Thank you so much.
Savita, the slide is stuck on
Is
the
stuck? Okay.
first slide.
Oh, is it?
Yes.
Are you able to see it now or no?
Still stuck.
Can you help?
بغلت واحد.
So
Just wanted to check before I move on. Are you able to see the slide? What else should capital market players be wary of? Is that what you can see, Razan?
On okay. Okay. On a stuck.
Yeah, Ahmed. Okay, fine. I think it's fine. Okay, thank you. Thank you so much. I think it's yeah. It's yeah. Thank you so much. Okay, so let's continue. Yeah. So, yeah, trust. We need to be aware of trust because, again, if it is a trust, we should know who the settler is, source of fund of settler, who are the beneficiaries of the trust, domicile of the trust. So, these are some of the due diligence we have to undertake when a trust is a customer, because trust can be used to hide beneficial ownership. And if the settler is the sole beneficiary, always remember that's a big red flag. If the settler is the sole beneficiary, it's a big red flag. Then entities with complex ownership structures, right? Entities owned by other entities, owned by other entities. See, you may unwrap to the extent of 10%, 5%, but the rationale behind a complex structure should always be thought about. And then the next red flag, which we as capital market players need to be careful about, is use of professional intermediaries to create entities like enablers. We have this term called enablers or gatekeepers, lawyers, auditors, accountants. Yeah, they can be used as to set up entities, right? Company service providers, yeah, TCSPs, trust and company service providers. These are all the vulnerable enablers, as you may call them. So if a customer is being set up using a professional intermediary, you need to do some. And I'm not saying it's illegal, right? But for us, it is a vulnerability. All we need to do is additional due diligence. Entities represented by professional intermediaries. No, so when the customer doesn't appear to you doesn't do it directly, but uses a third party like an enabler or a gatekeeper, it is another red flag for you. So this, my friends, we should be, as capital market players, we should be wary of. So who is a beneficial owner? Okay, okay, fair enough. I've talked so much about beneficial owner. So who exactly is a beneficial owner? I would like to keep things very simple. So simply put, a beneficial owner is the natural person. So entity owned by entity owned by entity, even to whatever extent, you need to reach the natural person who ultimately controls the transaction or benefits from the transaction, right? So you have to look at both in the sense that whoever ultimately controls, so it can be controlled by way of fund movements, it can be controlled by ownership of the shares, which has shares or bonds which has been purchased, it can be controlled by the amount used to purchase this fund. So this control, who is the person who ultimately benefits from the transaction, who or controls this transaction, is the ultimate beneficial owner. So you as capital market players need to understand who is the natural person who controls the entity. So all these entities which I'm talking about are vulnerable. So if you have a customer in the form of these entities, your due diligence should be enhanced, right? To the extent of knowing who the ultimate beneficial owner is. Right. Another trend that we are observing nowadays is use of Smurfs to hide beneficial ownership. This is another trend we are observing. Now, the cartoon looks a bit, why have I put a mule? It's a mule and a Smurf. Yeah, why have I put them? A mule is a money mules being used for money laundering. So who is a Smurf? Yeah. There is no strict definition of Smurf by FATF or anything, but just to understand, to enhance our understanding, a Smurf can be a money mule or a runner who launders or helps launder money by structuring. Okay, so a Smurf is a person who helps someone to launder money, knowingly or unknowingly. That is why I said wittingly or unwittingly. So for example, like I said, for identifying a person to set up and appointing him or her as the nominee shareholder or nominee director of a company, and using the entity to do the trading for you using laundered funds, right? So the use of a third party to set up these entities these are called the Smurfs. The third party who is used to set up the entity is called the Smurf. So again, as I said, they may be witting or unwitting. They may know or they may not be aware that they are being used to set up entities. The but the ultimate beneficial owner, the UBO, remains hidden. So even as investors, sometimes as investors, when we are approached by someone for being used, for doing a transaction on behalf of someone, or using our accounts for trading purposes, it should be a strict no, because we don't want to end up being used as smurfs. So as capital market players, again, use of Smurf is becoming very common. So please identify the red flags of a third party being used for setting up entities, or being, when you see the ownership structure, it shows a third party as the ownership, etc. Okay, so we have been identifying the red flags. We have been discussing the vulnerability. So there should be some response. What has happened? So FATF, the Financial Action Task Force, they came out with a recommendation, amendment to Recommendation 24. Strictly speaking, it is not a regulatory response, but yes, it is. FATF has come out with a amended recommendation, and it's for countries to adapt this recommended changes. Well, what did FATF do? They came out with an amended R24, which says that every country, which recommends that every country should create a public registry, which should have information on the company name, proof of incorporation, list of directors, along with the director's identification number, TIN numbers, which is the tax identification numbers, etc. And they also have said that nominee shareholders and directors should disclose their nominee status. You understand? So, which means they are bringing in transparency in entities. Yeah, they want to talk. There is a transparency. They want to enhance the transparency requirements of unlisted entities. Yeah. So this is what FATF has brought in as a recommendation. So how does it help us? Fair enough. This is an amended recommendation. How does this help us as capital market players? Capital market players can use this information to try and reach the beneficial owners. So you can try and reach the beneficial owners by looking up at public registries of countries from where your customers are from. Complex ownership structure should be scrutinized closely, and if unable to reach the UBO, see, when you look at structures and it is a bit complex, like entity owned by another entity in different jurisdiction, etc., you have to take a call whether to accept or refuse a business. Yeah, if the structure is too complex and you're trying your best to unwrap and reach the UBO, you're not able to, try to rationalize. Why is this structure complex? What is the rationale behind such a complex structure? And if you're not able to reach the UBO, it is a call you have to take whether to accept or not to accept the business. Cross-border transactions between two entities with complex ownership could be a red flag. Yeah, the rationale, as I said, please try to identify the rationale behind the structures. Okay. I now move on. So as I said, the first trend which we discussed is mirror trading. In mirror trading, we identified the red flags and use of hiding beneficial ownership in in trading, and the vulnerabilities and what can be done is something we discussed. Now we go to other continuing trends and red flags. The other continuing trend is insider trading as a predicate offense. We all know that this is a continuing trend, nothing new about it. So use of material non-public information. So what are the red flags? So for me as a capital market player, what is my red flag? The first one is any stock purchases in advance of mergers, yeah, or acquisitions. Yes, Mohammed, you have a question. I can. Okay. But I'm not able to hear you. I'm sorry. You can always type in. Then buying securities before a positive announcement by an insider, or yeah, you see a trend of buying of securities before a positive announcement. selling securities before a negative announcement, sudden activity in the company's stock. These are all some of the red flags which can indicate insider trading and which is a predicate offense for money laundering. Wash trading as a predicate offense. Yeah. Then the other continuing, it's nothing new. As I said, wash trading is again a continuing offense. What are the red flags we should be careful of? Include frequent and symmetrical buying and selling of the same security in same quantities and similar prices. See, what is the difference? I just talked about mirror trading. Now I'm talking about wash trading. What is the difference? In wash trading, what happens is, let's say, it's me. It's me. So what I do is, let's say I buy 500 shares of a particular security, and at the same time I also sell 500 shares of the I buy 500 shares, I sell 500 shares at the same time. So what is happening is my portfolio remains the same. Only thing is the activity, the volume, you know, the activity looks like there is some activity in the particular stock. So that is what I'm doing, creating a what do you call creating a hype, as simple as that. But what is the difference between mirror trading and wash trading is, in mirror trading, two different entities are used. Though the owner is common, two different entities are used. Buying and selling occurs simultaneously with the same quantity. In wash trading, I do it myself. You got my point. So wash trading, so red flags which I should be careful of as a capital market player in wash trading is, again, frequent and symmetrical buying and selling of the same security in similar quantities at similar price, right? So there is no rationale, as I said, rationale behind the transaction. The same entity being both the buyer and seller. This is the difference, as I said earlier. The purchase and sale of the stock doesn't correspond to any significant news or events, right? And overall position of the trader remains the same, right? In mirror trading, I basically use a trade to move funds across borders. That's the intention. That is the, that's why I use mirror trading, right? Then the other continuing, rather I would say a recent trend, not a continuing trend, or rather a recent trend is greenwashing. So what is greenwashing? Again, a very simple definition is greenwashing refers to firms claiming to be ESG compliant where they are actually not. And as investors, is greenwashing a predicate offense? What has greenwashing to do with money laundering? As I said, greenwashing involves environmental crimes. Environmental crimes is all about, it's a predicate offense. And yes, end of the day, yeah, this comes within the ambit of financial crimes. So greenwashing refers to firms claiming to be ESG compliant to impress shareholders and stakeholders, but not really being so. Within greenwashing, we have brand greenwashing, claiming that the company's business model is more environmentally sustainable than it actually is, or product greenwashing, mislabeling or misselling a product as green or with vague green claims. So we have to be, for example, we have the new disclosure guidelines, etc., from the Bursa. We have to ensure that entities, investors, capital market players are adhere to these disclosure guidelines. Okay. Then, what are the red flags in capital market activities? So, to ensure that we are safe and protected, what are the red flags? The customer is domiciled in, or he is doing business in, or regularly transacting with counterparties in a jurisdiction that is known to be a bank secrecy haven, tax shelter, or high-risk geographic location. So, capital market players have to be updated about the high-risk jurisdictions, right? So you have to have a country risk analysis, and you have to ensure that from an AML perspective, I'm talking here purely from an AML perspective, which countries are high risk. So please do keep the updated profiles of FATF, be it FATF list or any other list which gives you Basel AML index, etc., which gives you the list of high-risk countries. Please do keep yourself updated and be aware of the high-risk countries. The customer has difficulty in describing the nature of his or her business or lacks general knowledge of the industry. This can be a smurf. This can indicate a smurf. The customer appears to be acting as an agent for an undisclosed principal and is reluctant to provide information. Another example of smurf. And payments are made by third parties, check or money transfers from a source that has no apparent connection to the customer. This is what I was referring to when I talked about hiding beneficial ownership. Right. Let us now move on to cryptocurrencies and money laundering. As I said, I'm not going to go into details of cryptos and money laundering. I'm going to touch upon it from a limited area of sanction breaches. But before I go, just wanted to touch upon certain terminologies like chain hopping. What is chain hopping? Is a technique that refers to converting one form of crypto into another and moving funds from one blockchain to another. Example, Bitcoin to Ethereum to Ripple using a virtual asset service provider, not doing detailed KYCs. The other is mixing and tumbling. This is the vulnerability, mixing and tumbling, where it takes a bunch of transactions all happening simultaneously and breaks the links of coins in each transaction by swapping them with other transactions happening simultaneously. The specific goal of this feature is to make transactions harder to trace back to specific owners and accounts. What stage do you recollect from money laundering? Anyone who can tell me what stage would this be? Any guesses? I have almost 37 participants here. Anyone can tell me which stage it is? Well, it can be a, okay, layering, right? They want to hide the audit trail by moving it far away from the source. Thank you, Ahmed. Thank you so much, Ahmed Miraj. Thank you. Yes, it is layering. Absolutely. So now, as I said, what is the context of discussing virtual assets here? Why are we discussing that? As I said, use in ransomware payments. As we all know, when ransomware attacks happen, normally the entities are asked to pay in cryptos, right? So how does it work? So first, the victim, which is obviously the entity which has been attacked by the ransomware, and then obviously then they have to convert their fiat currency into cryptos, right? So the depository institution which they have an account with, and they convert it into fiat currency using a convertible virtual currency exchange, or a VASP, as you may call, right? Right? And then this is what in stage number 4, this is where the tumbling or mixing happens. So you send when you pay them the cryptos, they send it to a tumbler or a mixer where the cryptos are mixed up, and then the trial is lost. Yeah, the trial is lost, and then it goes to another depository institution, again back to a CBC exchange, and then goes to the attacker or the affiliate of the attacker. So this is what happens. Okay, fair enough. Now, where are we in the where are we in this and why are we discussing this? Because this ransomware payments can be used in sanction evasion, right? So when this amount which we are paying can go to a sanctioned entity, right? End of the day, it is moving from a financial institution, isn't it? And a CVC exchange, so which is a regulated entity in Bahrain, right? A VASP, right? So it can be paid to sanctioned entity, may result in funding entities which are sanctioned, thus undermining sanctions. It can be paid to cyber actors, right? May embolden cyber actors to engage in future attacks. You are basic, so it may actually fund the cyber attacks to plan future attacks. And it is paid to criminals, so enables criminals and adversaries with a sanction nexus to profit and advance their illicit aims, right? So what can be done by virtual asset service providers to prevent this evasion? First thing is, before paying the ransom, try to identify whether the email domains are associated with any sanctioned jurisdiction. So this is one basic due diligence you need to do to ensure that if it is associated with any sanctioned jurisdiction. And the second one is do a screening of the crypto wallet address to see if it belongs to a designated individual, right? And I'm going to give you some examples in my next slide. So basically, one of the most important thing to do is a screening of the crypto wallet address to see if it belongs to a designated individual. Certain virtual currency wallet addresses are sanctioned by the OFAC on the SDN list. Yeah. So that is something, if you see here, this is where I was coming to. So for example, OFAC has designated some malicious cyber actors. So the ransomware variant infected 234,000 computers, which is called as, it is a developer of CryptoLocker, was designated in December 2016. Then targeted US government institutions and companies. The second one, which is in November 2018, OFAC designated 2 persons for providing support to a malicious cyber activity and identified 2 digital currency addresses used to funnel the Samsung ransomware. So one is CryptoLocker, the second one is Samsung. The next one is the third one, WannaCry. This is a very, infamous, rather, I shouldn't say famous, but infamous attack, WannaCry ransomware. This attack was linked to the Lazarus Group, a cyber criminal organization. OFAC designated the Lazarus Group and 2 subgroups in September 2019. So, as I said in my previous slide, please do screen the crypto wallet address to ensure that they are not on any of the screening list. So, what was the regulatory response? Again, we have been discussing issues and regulatory response. So, again, FATF, when I say regulatory response, strictly not a regulatory response. Yes, FATF, Financial Action Task Force, they have come out with, that's why I think I have put in as best practice response. The travel rule, FATF has brought a travel rule for cryptos. What does it say? The travel rule is a key AML CFT measure which mandates that virtual asset service providers obtain, hold, and exchange information about the originators and beneficiaries of the virtual asset transfers. Like we do for a traditional wire transfer, financial institutions, we have a travel rule, right? We do for our traditional wire transfers. Similarly, for virtual assets also, VASPs have to do this. This also extends to financial institutions, okay? The same obligations applies to financial institutions when sending or receiving virtual asset transfers on behalf of a customer. Effectively, this requires virtual asset service providers to securely share certain sender and receiver information with each other for cryptocurrency transactions. So this is basically the travel rule is to mitigate the risks of, again, the entire, if you look at our discussion, it all comes from the vulnerability comes from a lack of transparency, from a opaqueness, from something being opaque. You don't know who is the who you are dealing with. So the answer, the solution to most of the problems is if you know whom you are dealing with, and if you know where the funds are coming from, and if you know where the funds are going to, right? So the travel rule is one such response where it says that the VASP should have information, the virtual asset service providers, should have information about the originator and beneficiary of the virtual assets. So that brings us to the end of this short webinar on emerging trends, AML trends, and continuing trends in AML and capital markets. We are open for questions. If any of you have a question, please feel free to ask. Anyone? Do you have a question? Do you have questions? You can use the chat box. You can use the, you can switch on your mics and you can ask questions if you do have any questions.
Hi, Savita.
Hi, Ahmed.
No questions from my side. It's all clear. I just wanted to thank you for changing the date of the workshop. I really appreciate it.
Oh, welcome, Ahmed. End of the day, we want you to benefit from this. So happy to do this. Thank you. Thank you so much.
Yes, thank you. Thank you so much.
Thank you. Thank you. Anyone else? Any questions here? Okay. So, assuming there are no questions, thank you so much for attending this. If you do need the slides, let me know. We can share it with you. And yeah, if you have any further questions, you can drop me a mail at savita@bibf.com. More than happy to answer. Thank you so much. And yes, I'm here. If you have questions, feel free to ask.
Thank you, Savita.
Thank you, Zainab. Thank you so much. Yes, Maria. The slides would be sent across. Yeah, do drop a mail to Munira or me. We will send you the slides. Not a problem. Definitely. Thank you, Maria. Hi, Ms. Fur, do you have any questions for the webinar? I can see you just joined. If